Hey everybody, this is Jose Blasco. We are now starting the session. Welcome everybody. Today is March 2nd, 2023, even though I'm noticing the date is wrong on the screen. So, sorry about that. My name is Jose Blasco. I will be leading the session today. Today is our monthly session for us to get together and to do some trading and review. So in this session, you are the protagonist, isn't it? In the sense that I'm here for you guys for sure. Happy to do some market analysis, happy to identify and discuss possible potential trading opportunities depending on different factors that we may be interested in checking. But at the same time, we meet once per month, and this is the time for me to hear from you guys and to help you better. As you can see on the screen, there is the information to access the chatting room, which is by using the app Speak Up. You can get that on Android as well as iPhones. You can also use the web version of it, which is web.speakup.info, and then you just need to key in the room key. I can see Mark, Joe, you are here already. Hello, my friends, and everyone else as you are joining the session. So just take a note of this room key so you can connect with us, interact, and make this session as good as possible. Also, I wanted to point at the disclaimer that you can read on the bottom part of the screen. So it's been running for a while. Actually, it's been in a loop, so you had the opportunity to read it multiple times. I am indeed counting on you guys to read it completely, as it is important stuff in the financial markets. So with all of this, I would say the session is now introduced. I am ready now to get rid of everything that we have on the screen apart from the charts, and we can now begin our session and looking at the markets and begin everything that has to do with whatever is it that you guys need. It could be reviewing some of the trades that you have taken. It could be some trade that you are looking to take this week, today, and you may have questions about the setup or how you are adjusting the trade. Okay, so let me know if that is okay. Yeah, the date was wrong, Mark. You're absolutely right. Today is March 2nd. You know what? Let me change it so that way it will be better. Sorry about that, guys. Just I guess silly mistake on my end to not to have rectified the date. Now you have it. Thanks for that, Mark. Appreciate it. Anyway, so I think that in order to give you time as well to type and to express yourself when it comes to how are things going, what are your needs, what are your questions, etc., etc. To give you a little bit of time, so what I'll do is I'll do my classical analysis of the markets, looking at the S&P 500 index, and that way I give you a little bit of time to chat. At the same time, I guess that this is such a generic analysis, which is absolutely key for no matter what we do. So I guess that it's not going to hurt if I go over it while I give you time to type your questions. Okay, so let's do that. So on the screen, okay, and this is for the ones of you joining the session for the first time. You may not have been with us for too long, so you may not know exactly what I'm about to do. Well, I just want to point at the fact that my chart on the left is the SPY ETF. So that's the S&P 500. Of course, we can also chart the S&P 500. We can also look at the S&P futures contract as well. But in the end, SPY is extremely liquid. And we look not only at the chart, but also we look at options data, and the options on the SPY are more liquid than the options on the S&P futures or the SPX index itself. And in that sense, it's probably the best market to analyze when it comes to doing what I'm about to do, which is to look at what is the market condition. Okay, what is the market condition? So SPY on the left, daily time frame, and on the bottom part of the screen, we are looking at auto climate, where if we look at what is currently happening with the climate, is that we are in a down climate, which a few candles ago, as you can see, was pointing at thin dots, but now is back to thick dots as the market is giving an extra push to the downside. The climate condition, statistically speaking, is unsustainable. We've been in this climate for 9 candles. A normal thing to happen would be 4 candles on the way down. So we've kind of doubled that. Actually, I'm just noticing as well that I have stuff on the screen that may be covering what I'm doing. So let me start again. Here we go. Sorry about that. So I was saying that we've been in this climate for 9 candles. 4 is a normal thing to happen based on statistics. One standard deviation of climate duration would be 4. So of course, getting to double than that, it means 2 standard deviations. So it's quite extreme now. So 9 is definitely a number that, statistically speaking, would be unsustainable. Even though for the ones of you that are new to trading, or you don't use statistics or probabilities on your everyday life, know that even something that is 99% probable still have 1% of the opposite thing to happen. So probabilities is never a certainty, even though as traders is a great reference for us to anticipate what may be about to happen, and therefore position ourselves in ways that more often than not, because it's stats, more often than not, we are on the right side of the market. And if we're on the wrong side of the market, in everything we do, we always manage our risk in order to not to get hurt too badly when wrong, okay? Which that obviously happens too. So, and again, for the ones of you that are trading for a while, you know this, but for the ones of you listening that are newer to trading, so that's an important concept to keep in mind. Now, on the left, apart from the count, which I mentioned a moment ago, okay, on the left, we have what's called the max distance. And the max distance has to do with, how far and how fast a market has gone. Not for how long a market is moving in certain direction, but in that direction, how far and how fast it went. Because the faster it went and the faster it went, the less sustainable the move is. Okay, so we are looking at sustainability from two angles, from duration as well as from extension, okay, which is the max distance thing. So in this case, the current climate has extended up to 133. That was on that day. Okay, that is 133, where two standard deviation of something great is 1.03. So we have surpassed what too far too fast is to the downside, and we have surpassed the normal duration of the climate when it comes to duration, when it comes to count. So in other words, this climate is not sustainable, and we should see a change of direction sooner than later. Okay, now, and you can see it if you're looking at this visually. I guess we'll agree this is a very powerful move on the way down. We had another very powerful move on the way down, so you can see how the climate extended below 4 dots. Same is happening now, and what we had after, potentially it could be a very powerful move to the upside. So we are in that particular situation right now with the S&P, and one of the reasons why, to be honest, the market just kept dropping and dropping and dropping. So let me show a daily time frame of the SPY. This is a 2-day time frame, for example. So notice how there is no green UFO until much later. Okay, and this has been happening for a while, by the way. Okay, this has been happening for a while. But the S&P has been falling, and it's not like there are too many UFOs, green-colored UFOs, anywhere close by. Okay, but now you can see that now in intraday timeframes as well, we are now getting closer to green UFOs. This, together with a very tired climate on the way down, should do and should provide a turning point to the upside. Of course, all of those are anticipations that imply that we as traders are getting ready to execute a trade in that direction. But it doesn't mean you're going to take the trade in the direction hoping what I just said is going to happen. Because an anticipation, another word for anticipation is preparation. You are getting ready for action, but it doesn't mean you're going to take action unless you have that confirmation. So confirmation in this case would mean that we need to see a blue dot show up on the auto climate. That would confirm everything I said. It's now becoming a reality, and now taking action would lead to probably much better results, instead of somewhere in the middle of this climate you already expected what I just explained to happen, but it didn't, and now the market is moving against you severely. So we don't want to act based on hope. We want to anticipate, to be ready and not to miss the trade, but we only act when what we anticipated is actually being confirmed. So then we can act with confidence. We can act on a timely manner because we were preparing for it. And that's why I'm making these comments. Okay, so this is not financial advice. Second, this is not a comment for someone out there to just go crazy with a trade, buying with everything you have in your account. It's not the case at all. Okay, this is not how we approach trading. And for the ones of you that are veterans, of course, you know exactly what I'm saying, and you heard me say that a million times. But for the ones of you that are newer to trading, it's critical that you understand that, because of course some of my words are, I'm just trying to be very clear with my explanation, so all is understood. And by being very clear, obviously I'm using words that imply a lot of confidence. And you may be new to trading, and next thing you know, you think that that's it, let's buy right now. No, that's not what I said. What I said is we have a market condition which is down, which is unsustainable statistically speaking, but we have not had the change of climate happening yet. So we need to be patient and wait for that to happen. We are just going to be preparing for it, okay? Good. Now, why else am I pretty positive in these comments, expecting a change of climate that could be something like that? Why? Well, because when we look at the two lines that we have below, the volatility comparison, we have the blue line that represents the implied volatility for the calls, okay, IV calls, and we have the gray line, which represents the implied volatility for the puts, okay? So the implied volatility for the calls being above the implied volatility for the puts, blue above the gray, can only be achieved because of one of the two cases I am about to mention, which is, listen carefully, more people buy calls than puts, which is bullish, or more people sell calls than buy puts, which is, sorry, let me rephrase that. More people sell puts than sell calls, not buy calls, sell calls. So more selling of puts than calls and more buying of calls than puts. In both cases, we don't know which one is the one that is happening, but in both cases, buying more calls than puts is bullish, and selling more puts than selling calls is also bullish. So the blue line above the gray line, it's telling us they are buyers in the market. Now, again, it doesn't mean the buyers are buying now. It means there are buyers in the market. We don't know at what price. The current price of the S&P is currently 393. Maybe the buyers are located at 390. Maybe the buyers are located at current price. Maybe the buyers are located just a little higher than the current price, expecting for a confirmation of a move up and buy then with a confirmation. We don't know for sure. Of course, we can certainly use the UFOs, and they are buyers at 386. That we know. But again, we are not talking about the buy orders that could be sitting at some price point. We are talking about overall across all price points available in the market. We have buyers or sellers, and in this case, we have buyers. So there are buyers in the market. The only situation that we have right now is that the market is falling. So those buyers are probably waiting to buy, or maybe they have been taking a lot of profits, and that's why the market has been falling. And again, we still have buyers in the market. We have the evidence thanks to the blue line being above the gray line, and therefore we are now waiting for that confirmation, and that should give us a good level of confidence to get into trades, betting on the upside once that happens. Okay, now, having a great level of confidence is great because you execute on time, but again, every trade that you take should be managed in a way where the risk is totally under control. You don't want to bet, everything you've got in one trade. Everything needs to match the rules of your trading plan. Classical rule is not to reach more than 2% per trade. So again, this may mean that you take the trade with one contract or 5 contracts, depending on your account size. So whatever that is, but again, every trade, no matter how well we plan it, is subject to not to work successfully, and therefore managing the risk is what will keep us alive through time in order to produce consistent results. You may take a few slaps on the face from time to time. This is part of trading, but those slaps on the face are not punches; they're just slaps. So you can survive it. Okay, and then when the trades that profit come, so that will grow your account because when it was not working well, you had limited the level of pain, so it's easier to survive versus if you got into trades that are too large with too much risk because you were too confident. Okay, so we have to be confident, so we execute on time, so we are not undecided. But we cannot be overconfident or even worse, arrogant, where we think we know better than the market. Okay, so no matter how experienced we are, we all traders go through cycles where we have profits and we have losses, and it's a combination of both always for the rest of our lives. Okay, so there is no way to trade where it's all profits, and that doesn't exist. Okay. Great. Okay, so let me see. I'm looking at comments on the chat box. I see Joe, good methodology. Well, that's very appreciated, my friend. But I do not see any additional comments or questions, which it's a shame in the sense that we are meeting once a month, and I would certainly love to hear from you when it comes to what is it that you need. I mean, I guess that's fair enough, and I will bring something to the screen. in just a moment. I just need to load something, and I will bring it to the screen so you guys know. And this is again something I want to share, especially for the newer members in our community, which you may not know. Just loading a web browser on another screen. Okay, bringing it here now. Okay. So this is our website, and if I scroll all the way to the bottom, so there is something called the traders meetings, okay? Which those trader meetings, if I show you the calendar, we do those meetings twice a month. We started last month in February actually. So the next meeting actually will be next Monday, Monday 6th, the UFO traders open meetings, okay? And the next one will be on the 20th, okay? So, UFO trader meetings this month will be on the 6th and the 20th. So those are meetings for you guys to join me, and it's not going to be a webinar style like this one. In this, you will be sharing your screen like I share my screen, and we'll be looking at trade setups and whatever you'd like. It could be maybe how to place a bracket order with your broker, whatever. It could be anything. So we'll talk about it. Okay, this is like a friends meeting where we trade together. Okay, and I may take the role of a coach if that's needed, but I don't have to. You may be the coach. You may be the one sharing your screen and showing something to the rest of the traders. Today is not like that. Okay, today we are doing the trading and review, where I am now 100% wearing the hat of being your coach, ready to review what you're doing, keeping you accountable, adding more when it comes to your knowledge, education, skill, whatever I can do. That's what I'm doing today, and therefore I need your participation the most as possible. Mark, I always enjoy your current analysis. Thank you so much, Mark. That's very nice to hear. That's very nice to hear. But you guys don't need to be nice to me. You guys can also flood me with many questions, and that way I can also take care of that. Okay. But anyway, so well, since I don't see too much activity when it comes to your questions, and maybe you are also still getting used to the new format of the sessions that we changed some time ago, and fair enough. So while that's the case, I'm gonna propose to look for some sort of a trade opportunity that may work well with the type of market environment I just described, and maybe that could be an exercise we can do. But again, while I do this exercise, certainly, no matter if it's related to this exercise or any other thing, feel free to type on the chat box, if you have questions and so on. Okay, again, this is the real purpose of today's session. So I want to discuss a type of trading opportunity which could be beneficial of a situation that we have now, because again, we seem to be dealing with a market condition which looks quite healthy, even though the market has been dropping from 417 to 392, and that's a relatively significant drop in percentages. And probably many people out there in the world are talking about it like, oh my god, the market is at risk, it's all bearish. Okay, I get it. It's a downtrend at this moment in time. But again, statistics tells us that this is more likely going to change sooner than later. Plus, what's very important, as I said before, is the fact that, from the options markets, we get to see evidence that buyers are around. Okay? Again, we don't know the price, but buyers are around. So I got two choices. I got the, let's call it the normal choice based on the methods that you have seen me utilize in many prior sessions, many of the videos that we have on the YouTube channel that if you are new, you can go and watch. And that method would imply to wait, as I said before, for a climate change, have something tangible to lean against, and from there look for stocks that are strong in a strong industry, etc., and plan on whatever trade makes the most sense. So that is something that it's my bread and butter and my favorite approach. But at the same time, the fact that the market is falling is also possibly a good source of little bargains here and there, where maybe acquiring certain stocks could be a good idea for a long-term portfolio. And in this case, you heard me well, even though my favorite approach to trading is options. In this case, I said acquiring some stocks, which of course, if I was to ever acquire stocks, then I would convert them into an options play. But at the same time, acquiring stocks could also be part of a long-term methodology, especially if you are planning to get some dividends, as a little bit of a variation of the income your account produces, and you can also get maybe some dividends. So maybe you can do that. Now, the problem is that if the market is falling, and let's say in the end I'm wrong, and the climate is just gonna double down, and the gray line is gonna go above the blue line, showing that now sellers are in control, and the market is gonna be crazy bearish, for 2 years. So then next thing you know, buying stocks at a current price now would be very problematic. You may get to see those stocks drop by 50% or more, and that would be very problematic. So the idea I want to exploit is, number one, finding stocks which may have setups that imply that buying them at a lower price could be advantageous, but also find stocks which are relatively cheap when it comes to the price per share, meaning that the most you can lose is what you pay for the stock, and if the stock is relatively cheap. So you can keep that in mind as your maximum risk for the trade and that would be a very conservative approach. Like, let's say I find a stock which is trading at $15 per share, and I was to buy that stock, and let's say the stock is again trading currently at $15 per share, and let's say I find an opportunity to buy it, let's say at $12 per share. Well, if I buy it at 12 instead of 15, I save myself $3 of pain, which on a $15 stock is a great percentage of avoidance of risk. But on top of that, now I got that stock at $12, and let's say I got 100 shares. So what's the most I can lose? Well, the most I can lose if the company goes bankrupt is 12 times 100, which is $1,200. Which again, if you are dealing with large accounts, that is a relatively low risk. Is that making sense? So in order to minimize the risk of a market which seemed to be bullish but hasn't proved it yet, I don't want to be overconfident. I want to be confident but not overconfident. And the way to tackle it is going to be using option strategies to try to get stocks at a cheaper price, but also make sure those stocks are not super expensive stocks. So if I end up being wrong, the price of the stock itself is acting as a risk management technique. Is that making sense? So how can I do that? Okay, and I can see another message here from Mark. So today would be the double calendar because the VIX is still relatively low. Okay, I get you. You will be correct. You will be correct. We are in a situation where it's unsustainable, statistically speaking, for the market to keep going down, but it's not being proven to go up yet. So being non-directional would be my favorite approach if I was to do one of the classical applications that I've done many times in prior sessions. So certainly I would be to be non-directional. And because the VIX is relatively low, so then you are right, double calendars, it would be a great option to look for opportunities. Okay, and maybe one good exercise could be, Mark, that you work in parallel with me and you set up a double calendar and then you tell me, and then maybe I can double check on the screen and we can discuss it, assuming you're okay to do that. You don't have to, okay? Maybe you're listening and making notes and it's too much multitasking, so I get it as well. So you decide. But since I presented a specific approach to this type of market condition, which is different than the one you said, because the one you said is more active trading, the one I just presented is more long-term investing, if you wish, a bit more passive. So what I'm going to do is I'm going to develop that one, since I already explained the whole rationale behind it. Okay, cool. Okay, so what do we want to do? Well, first I'm just going to bring in the matrix. And the reason why I'm going to bring in the matrix is because I want to do some filtering. Okay, so I want to trade stocks where, let's say, the maximum price of the stocks is going to be $25. Okay, and I'm going to have certain requirements for those stocks. Okay, so of course, as we said a million times, stocks are fragile. So if I want to get into some sort of a long-term play, I will want to see that stock on the long term belongs to sectors that are strong. Okay, these days we have a few of these type of opportunities. Okay, consumer services, consumer goods. It's not like there are that many, but it's not like there are that little amount. Okay, so if I look at long term, okay, so you can see how basic materials is blue long term, consumer goods is blue, consumer services is blue, financial is blue, not healthcare, industrials is blue long term, not oil and gas, technology is blue, and telecommunications is blue, and not utilities. Okay, so those sectors which are long-term blue, those are the ones that I would prefer to use in order to make sure that if the stock falls, which is what's happening, and I catch it at a lower price point, well, the stock has a greater chance to go back higher because it belongs to sectors or groups which are stronger in the long term. Even though temporarily they may be falling too, that's why the stock is falling too. In the long term, they are stronger. Okay, so I'm doing that kind of filtering, to find stocks of that sort, and that is giving me a fairly long list. Okay, so what else do I want to add? Well, because I want to catch that stock at a lower price, in order to do that, I would like to find stocks that have implied volatilities which are high. Okay, but now the highest volatility I want to find, to be honest, in this case is not the mean, is the put. So I'm going to be looking at continuous implied volatility for the puts to be greater than 80% of its range. So by doing that, now I have a shorter list. Okay, still okay, pretty long actually, but still shorter than before. And then what I want to do is, remember when we said for the S&P that there were buyers on board? So I want to find setups where I got buyers on board for the stock itself. So that I'm going to accomplish it by looking at top positive continuous implied volatility spread. That means that the blue line is above the gray for those stocks. Okay. Here we go. And now I got this particular list. Okay, this is the list I've got. Okay, so let's take a look at those stocks, because of course many of those stocks may not be that liquid. At the same time, that may represent very good opportunities for that kind of for that kind of I lost the word I want to use. For that kind of trading setup, if you wish, we want to look for very unique type of stocks. Normally, you see me load the scan list with, penny increment stocks, right? Penny increment options. In this case, I'm not going to do it. Okay, why? Because then I'm going to get the most liquid stocks in the world, and therefore, while that's great, I may miss on some of those very good opportunities for stocks that are lower price point, etc., etc. Because again, the stocks at a lower price point, probably they're going to be a bit less liquid than stocks that may be trading at $50 per share or more, right? So I'm not going to filter based on that list. Okay. So what do we have? Here I'm using just a little bit of experience, if you wish, okay? And certainly I am attracted to a few companies here that I see. SLM would be one that could be interesting. Consumer Financials. This is a stock which is currently trading at $13, so that could be interesting to observe. Again, this is also the place where you could add, if you'd like, a little bit of. If I say fundamental analysis, maybe I go too far, especially because my style is really to be technical. But you can add a little bit of surface level fundamental analysis when it comes to understanding the type of companies they are, just to know what is it that you are adding to your portfolio, and also to avoid diversification. Because let's say you do this 3 times, and the 3 stocks you get in your account belong to the very same type of company, then you are not diversifying yourself. So you will want to know a little bit more about those companies. When you do this type of application, you probably end up with a small list of stocks like I did. And again, you are opening the door to acquiring shares of those companies. So you need to do your homework, right? And that may imply that, maybe 40% of the stocks we see here, you just discard them, okay? And you end up with a much smaller list. So in this case, I'm just gonna check SLM, okay? And I'm gonna look at the chart and see how the chart of SLM look like. And we can see the stock has been falling very, very aggressively from 17 to 13. For certainly looks like that if we buy that stock, we are buying a bargain. It's very, very cheap. Now, of course, it may keep going down, and then you bought a problem, not a bargain. So let's do a little bit of technical analysis here to look at what do we have here. And you can see here that around 13 in the 2-day time frame, we got 60% UFOs. If we look at the 3-day time frame, UFOs with 54% are located more like 1153. So I would say, if I go back to the other one, 1156 is also here. So definitely, if you want to be very conservative, maybe shooting for 12 makes a lot of sense. I would say that after the huge amount of pain this stock already had, probably shooting for 13, may be good enough. Okay, but I'm not very happy about 13 because of the fact that If the stock bounces from 13, the moment it gets to 13.94, you got a red UFO there, so probably it would be, it's wise to take profits and close the trade. So there is less room for profit if we use 13 versus 11.56. Probably gonna be end up running to 12. That the option chain will tell me, because I'm pretty sure I'm not gonna have the best liquidity in the world here. So what do we have if we look at 12? If we look at 12, we are looking at ask 35 bid 10. 271.95. So you can see the liquidity, it's definitely not too good. You can see some volume here, but not too much. Okay, again, I'm not surprised about this because of the type of filtering I've done to get to that stock. This is obviously not ideal, but this is also often how it looks like to find unique opportunities to fish stocks, with the conditions I described before. Okay, because we're looking for these unique opportunities with lower price points. So this is how an option chain will tend to look. So of course we don't have 11.56, so I guess that 12 would be the way to go for that one. And before I keep going with this, if I'm going to shoot for 12, I will want to find out. I'm going to use my strategy builder here. I will want to find out how long it should take to get to 12, and the target date here would be April. Okay, April 2023. So in other words, whatever I do with that stock with options would have me use at least April expiration, not before April. At least April expiration. Okay, let me move back to the 3-day. So April expiration will be the minimum for me to use. So let's go back to the option chain, and let's look at the available expiration dates. So we got April, and then we got July and October. Okay, that's what we have. So let's take a look at 12, and let's see what we have. So we have 75, 35, 35, 10, okay, and then 1 and 55. So it's looking to me that October expiration is probably the most adequate from a liquidity point of view. So even though the bid-ask spread is quite wide, but 45 cents for $1 is kind of better than 40 cents for 75 cents, isn't it? So October seems to be a bit more adequate. And this, of course, is going to be something that if we do it, we need to be like super negotiators who can put the order in, and maybe you have to wait multiple days until you get filled. Maybe you don't get filled, and then it's fine. But you just cannot go market orders here, okay? Please. I guess it's obvious, but again, just in case you are new. So I'm going to look at October expiration. And first, I want to discuss what if I sell the 12 put using October expiration. Well, if I sell the 12 put using October expiration, we have a very simple setup by which if that stock stays where it is or above, stays above 12, so you're going to make 78 cents in 200 something days. That was how many days? 32 days. So if I bring a calculator here and we do some math, okay, so you make 78 cents, which is the midpoint, right, in 232 days. In 232 days, okay, but you have 365 days in a year, okay. So and in order for you to do that, you need, let me do the math properly, you're gonna make 78 cents out of tying up $12, okay, and you do that in 232 days, knowing that a year got 365 days. So that is 10%. Okay. So if you sell that put and nothing happens, meaning the stock went higher, so you made 10%. Of course, you make 10% on a $12 stock. So that is 78 cents times 100, that's $78. You are not going to become a millionaire doing that. But it's very low risk, because if that stock is assigned to you, again, it's a low price stock, and therefore, if you use a percentage of your portfolio for stock allocation, and one of your components is SLM, so then you have a worst case situation, which is probably very well under control given the fact that the price of the stock is low. The return on investment of selling the put 10% is not amazing. It's not bad either. So it's not like you're being paid 2%. So this is more than interest rates. So again, for a conservative portfolio, that will not be too bad. Okay, but the one thing that is interesting here, and I'm going to try to make this better, is the fact that if the stock drops to 12 or below, and shares are put to you, and now you own stock at 12, so the fact is that you got paid 78 to own the stock at 12, so your net entry price into the trade is actually 11.22. So you own a stock that cost you 12, but you got paid 78 cents to own the stock at 12. So your net entry cost is 11.22. So if the stock now goes bankrupt, you don't lose $12, you lose 11.22, which is great for risk management. So things go well, you make 10%. Things go bad, you get the stock put to you at 11.22. To be honest, that's not things go bad. That's things go according to plan, because you sell a put if you want the stock put to you. If you don't want the stock put to you, you don't sell the put. So having the stock go down to 12, it's not things go bad. Even though I phrase it this way, you know what I mean. Okay, it's actually what you want. So then the question is, worst case, you got $11.22 at risk. Can we find a way to make this better? Okay, that's the plan. Okay, and the answer is yes, even though it would depend on the liquidity we have, where sometimes what I'm about to do may work or may not work. So here is the idea. The idea is that instead of selling the 12 put by itself, what you could do is that you could buy the put above, okay, creating a bear put spread. Now, of course, that's not going to be a credit, that's going to be a debit. Okay, so you pay 30 cents to do that. Okay, you buy the 13 put and you sell the 12 put. Okay, that's a bearish trade with a negative delta, and you need the stock to drop to make money. Okay, so that's a directional trade short. Well, here we were talking about acquiring shares of stock. So, Jose, what are you doing? Well, take a look. If I buy the 13 and instead of selling one of the 12, I sell two. Okay, I sell two. So my credit, instead of 78, it's going to be 47. Joe, I hear you, my friend. I'm reading your question. I'm coming to you in just a moment. Okay, just I'll finish the technical part of the trade first. Okay. So if you buy the 13 put and then instead of selling one, you sell two of the 12 put. So your net credit is going to be 47, which is less than 78. So in other words, if I do the math, now you're going to make 47 cents out of tying up $12. This is divided to 32 times 365. That's not going to be 10% anymore. This is now 6%. Okay, so instead of making 10%, you make 6%. So that's worse. Okay, in case the stock goes higher, that's worse. But in case you want to mitigate your portfolio risk, and the stock is put to you, okay, so the stock drops all the way and is put to you. So what's going to happen is that the stock is put to you at 12 minus 47. So your net entry price is 11.53, right? But in the process of getting the stock put to you, you made $1, which is the difference between 13 and 12, right? So in other words, because you made $1, right, the net profit taken from this approach is not the 47 cents of credit. The net income collected from this trade is actually $1.47. So you have $1 less of risk because you made $1 on the trade, which brings in the net cost basis of this trade to 10.53. So now instead of having a risk of, we said before, 11.22, so now your risk is 10.53, which is obviously less of a risk. So again, this is a conservative approach, which is the whole thing I was explaining earlier since the beginning. Because why is conservative? Because again, the market is falling. We've got buyers in the market, but what if I'm wrong and it keeps crashing like crazy? So we want to be conservative. So how am I making myself conservative? Well, first, looking for a cheap stock. Second, allocating only a portion of my capital to that stock, knowing that I will have other stocks in my portfolio, hopefully that belong to different groups, diversify in different ways, etc. But on top of that, now when it comes to acquiring the stock, I'm not just buying the stock, I'm selling a put, so I can buy it at a lower price. But now on top of that, I'm not selling a put, I am actually buying a bear put spread and selling an extra put. So the extra put I sell, it's the same one put that will get the stock put to me, assuming that company share is going to fall down. But the beauty is that because I did a bear put spread together, I still ended up with a credit, and I'm going to end up with an extra $1 profit if the whole thing collapses, bringing my net acquisition cost to be 10.53, which is obviously more advantageous than 11.22. What's the downside? The downside is that if the stock doesn't fall and goes higher, instead of making 78 cents, which is 10%, I'll make 47 cents, which is 6%. But again, if you're conservative, I guess we all agree that less risk, less reward, and it's fair, right? So here's an additional choice for your consideration that could be interesting. Okay, so I'm just gonna put the trade in the account, and then I'll we'll be discussing Joe's comment. In the meantime, by the way, I'd love to hear your thoughts on the chat. And by the way, in case someone joined the session late, here is the speak up room. The room key is here in case you join late, so you can connect with us quickly. So if you have anything to say about the plan I just presented, you just let me know. And if you don't have anything to say, but you did follow the plan and you understand, no matter if you like it or you don't like it, or if you plan to implement it or you don't plan to implement it, just from a just for me, I'm being selfish here, just so I know you got me, which is a very useful feedback for me, guys. Please type it on the chat box. Quick okay would do, or if you have anything else to add, please go ahead and do it. So let me bring TOS. I'm going to trade using SLM. And I'm going to be looking at 20 October 2023. And we said we're going to be selling, sorry, not selling. We're going to be buying the 13 and selling 2 of the 12. Okay, I'm bringing that credit. Ahmed, sorry about that. Yes, I should have thought about flashing the room key a few more times. I was just focused on the trade and the explanation, and yeah, not ideal. So anyway, so here it is. Okay, so buying the 13 put, selling 2 of the 12 for this theoretical midpoint credit of 47, which we may get or we may not get. I'm just going to place the order, confirm and send, and okay, your buying power will be 0 NA. Okay, interesting. So I guess that there is a problem here with the demo account here. Why is that? $93,000. I don't see the problem with the buying power. Let me review what I did. I must have done a mistake, or maybe there is a little glitch at the moment. Okay. So buying power effect 150, maximum loss 1053. So I don't see what's the problem is. Maybe a problem with the demo account at this moment in time. It looks like it took it now. Okay. Maybe I made a mistake earlier. Not sure. Mark, I like the trade strategy, just a little worried about the SLM due to politics. Okay, got you. So let me go back to Joe's comment. SLM is a student lender. How might any political conflict about student loan debt affect the price of the stock? So my answer to this, and I totally get you both, Joe and Mark, when it comes to this, and of course, I don't know for sure, okay, even though I'm going to comment based on other things I've seen before happening. and I would think that this would be the case as well. But of course, how can politics or can affect a stock? How can something crazy happening in the world? We saw that in 2020 with a pandemic, right? So you never know for sure, right? So that's why on top of what I'm about to say, the beauty of a play of this sort is the fact that your risk is contained. Even if the stock goes to zero, the most you can lose in this case is $10.53. Is that making sense? So that's the whole thing, okay, that I started with. So because that's the whole thing I started with, one very easy answer to your question, and please don't take me the wrong way, is who cares? Okay? Don't take me the wrong way. But it's true because politics are there, and definitely they may have an impact in the market. But how many times you've seen the impact of whatever happened because of something political, and you saw the impact in the market to be the complete opposite, right? So, we see that every first Friday of the month with the unemployment number, for example. So, don't get me the wrong way, but I could just say, who cares? And probably I'm right if I say that, okay? But now, having said that, and putting that on the side is extremely pragmatic way to think about the market. Nothing wrong with it, by the way. Putting that on the side, let me give you a little bit of a more complete answer to your concern, Joe. A very fair and very valid point. So here's what I've seen happen many times with important news, for example, coming from a political angle, or specific sectors in specific industries which could be critical. So, for example, you're talking about education. In my mind, there is a major situation right now when it comes to educational companies around the world. I mean, I think the educational industry is about to change like we've never seen before. All the way, we are about to see so many, universities probably just even disappear. Probably mergers and all sorts of things, but probably even disappear. And why? Why? Well, again, I don't have a crystal ball, but I guess we all know what's happening out there in the world of technology, especially with AI, right? I'm sure that all of us are using intensively in a regular basis tools like ChatGPT, for example, right, or other AI tools. I personally use them for a long time, and certainly ChatGPT being free is something that I use intensively since last year in December. So, there are many other tools like Bing, the browser of Microsoft, right? The search engine of Microsoft is now giving you also access to AI type of searches. So again, you can actually go ahead and learn in a way that is so much more advanced, many topics than before, utilizing AI, meaning that many of the educational companies that currently exist will have to charge much less for their education materials, or maybe not even justify at all, charge for it. Okay. This applies to us as well. We as a company, we are not an educational firm, but as you probably know, on our website there is a collection of courses. So our courses are extremely useful, but for sure there is plenty of information in the courses that could be learned very well by using tools such as ChatGPT. For example, you want to learn about future symbology to trade a specific futures contract. You want to learn about trading hours. You want to learn about long short. You want to learn about various contingency measures. For example, how to hedge a trade. There's so many things you can learn with AI tools that don't imply the use of educational materials that are paid at all, like zero. So so that's the world in which we are, and that may have a direct effect on companies that have currently clients paying for loans that may decide, why am I paying for loans for a product that I'm not using anymore? A product has no value. I'm not paying my loan anymore. I mean, that's not a serious approach. It's definitely against the law, but I'm pretty sure many people would think this way. So what could happen to those companies? What could the government do to offset all those problems? Who knows? Again, going back to my pragmatic approach, who cares? But again, definitely whatever is it that they do may have an impact. Okay, and in cases like that, every time in the past, we could point at so many things. For example, 08, major intervention from the government when the stock market was crashing like crazy, banning shorting stocks that belong to finance, adding billions of dollars of money into the system to try to recover the market. So again, those things do what? Well, many times it does not too much. Many times it does even It makes it even worse because the fact that the government is doing something about it creates even more fear. But then whatever it does in the end is to kind of, and this is my conclusion, is to kind of accelerate whatever was going to happen anyway. It just happens faster because all of those interventions or so much talk about certain things just create more volatility in the marketplace, bringing things to be where they need to be anyway in the end. In this case, if I was to come back to the chart of SLM, and I was to go back to that 3-day time frame where we saw those on-field orders located at 11.56, but the current price of the stock is trading at 13.85. So maybe you have this crazy news, crazy something happening from the government, blah blah blah. This company is about to go bankrupt. The government steps in and maybe bails them out, or maybe some merger is taking place, and now the government is realizing many educational companies are in trouble, or loan companies are in trouble, and next thing you know, they are acting on it. And what happens is that now the stock is falling like a rock, like crazy, right? And a drop from the current price from 13 to 11.53. I mean, let's do some math. So from 13.84 to 11.56, that, did I do the math correctly? No. 13.84 minus 11.56, that is a $2 move, right? Out of 15.84, which is the current price. So that is 16% drop. So imagine that you see that stock falling 16%, let's say in 2 days, while on TV they are saying crazy things. So what's the result of that? Well, the result of that is that whatever was going to happen is going to happen faster anyway, which is the stock gets to where the buy orders are. All of those buy orders are set in the marketplace because of certain market players which are large and intelligent. And guess what? So what's going to happen then is that the stock goes from 11 to 14 in 2 months, and all this market volatility where this was crashing like the world is ending, and then everybody realized that the world didn't end, and now everybody starts buying. And guess what? Now you are in a red UFO, price goes down again, right? So these kind of things is what tends to happen with those very big news. They kind of accelerate what was going to happen anyway, which is price going to find where the buyers are and price going to find where the sellers are and react to the buying and the selling. That was going to happen anyway, but those very big news tend to accelerate it. So that's why earlier I had very pragmatic words for you, Joe, when I said, who cares, right? To be honest, I should not say who cares. I should say, I wish, because what would you rather do? Set a trade and wait 2 years for the trade to take place, or set a trade and it happens in 2 weeks or 2 months? So I guess that, market volatility, as long as we have risk under control and we understand what we're doing, so market volatility is certainly opportunity. We love it. Of course, in this case, we have the risk under control. The most we can lose on this trade is 10.53. So, even if the stock was to go to zero, it's not the end of the world. And if this craziness, these talks, these political actions are taking place, and that's going to help in the end to just accelerate the whole thing. So thank you very much. That's what happens all the time. I mean, I would say the latest event that we saw that in larger time frames is 1 year ago, the war in Ukraine. Well, the war was ending, and basically we are back to where we were 1 year before. Nothing happened, right? In the marketplace, this happens consistently throughout the history of the markets. And then if you look at it intraday, it's the same story as well, right? So you look at the Fed raising interest rates, everybody going crazy when inflation numbers are reported and everything else. And then in the end, you look at what happened in the trade, and the market moved up, collection of handles on the way up, and then a collection of handles on the way down, and then maybe it kept going. But you had opportunities to trade in both directions, probably most of the times, isn't it? So yeah, so that's my 2 cents, even though it was a long explanation. But yeah, so yeah, we'd love to hear your thoughts. Again, you may have had different experiences. You may want to add to it. Okay, I'm not here while I'm acting as your coach. It's not like I know everything and I've seen everything. I'm in the market since 2008, so I've seen a lot, I would say. But of course, I'm not a 50-year-old trading veteran. Okay, so you guys may have seen things I haven't, and you may have different opinions or different experiences that I didn't have. Okay. while I'm waiting for your comments there on the chat box, I'll add one more thing. I remember there was a time, what was that company? It was Rambus, a tech company from the Bay Area of San Francisco. I remember I had this pretty aggressive trade on, where I was selling puts below price and stuff. And so that stock, and I was a new trader at the time. Okay, I was very novice, and I remember that something crazy happened with that company. With some rumors about some IP being stolen from that company, and some legal stuff going on. I don't remember all the details, but it was very big news. It was in the media everywhere. Everybody was talking about it at the time, and I remember that stock was dropping like multiple days in a row, like 15%, something like that. And my put strike was like maybe 30% below price or something like that. So it was a very conservative trade. I got very, very scared because of my lack of experience when those moves were happening towards my puts. And at some point, I decided to close the trade just to see that, a week or two later, the stock went basically back to where the origin of the move was. And actually, if I had the stock put to me, that would have been a great thing. But at the same time, it was very scary for me at the time, with lack of experience, to see those very extended moves in that particular direction, because it looked like the stock was going to go bankrupt. So again, I didn't have the best risk management in place at the time. If I had, probably I would not have been scared. Second, my perception, my lack of understanding of options at the time, a collection of things got me to get out, just to learn a big lesson from the market. And this is just a one-time event, so meaning other cases could lead to stocks go bankrupt. But again, if I had my risk under control, it would not have concerned me either. Is that making sense? So yeah, so not the biggest concern in the world. Okay. Let me see. I like the trade strategy. I understand your point of view. Thank you for that, Mark. Joe, to answer my email about monthly session breaks, could I load a template on one of the charts in the 7 chart page? You know what, Joe, this is very bad of me, to be honest, but I have not read your email. And I saw your email coming in, and I'm like, I need to read that email. And then I'm now realizing I forgot, and that's why I didn't respond to you. So I'm very, very sorry about that. But if you don't mind, let me go and check your email so I know exactly the issue. I mean, I remember responding to your email, and you were supposed to send me your workspaces, which I guess that's what it is. But I need to look at it. I have not. I'm really sorry about that, Joe. Sometimes I'm a bit slow responding emails, but in this case, I just have to be transparent with you. I just totally forgot. I saw it coming in. I'm like, I'll look at it later. I guess I went over confident there with the time zones, because I'm like, if I respond to Joe now, it's gonna be asleep anyway. So I'll respond to Joe later, and then I have to admit I forgot. Sorry about that, Joe. I'll get back to you. Okay. Cool. Okay. So I guess we are now reaching the end of the session. Then I see that there are no more comments or questions on the chat box. So I guess that would mean that probably it's time to conclude the session. Well, my friends, it's always a pleasure to spend time with you. Make sure you are ready with questions as well for future monthly sessions, okay? This applies to all the coaches. So our monthly sessions become trade and review. So we can focus on the trading when we do the open meetings, okay? So we use the sessions for what they're designed for sure. Always happy to convert a session on whatever is needed for you guys, okay? But at the same time, if we are organized, I guess it's also better. So be ready for future sessions. Take care, my friends. Always a pleasure. Ahmed, good to see you, my friend. Sorry for sharing the key room a bit late. Do you see? That's the thing about the monthly sessions, is that we do them once a month. So sometimes you kind of lose the muscle memory on certain things. In this case, to share the room key a bit more, so I give you more time to join the session, because maybe you are not entering the room exactly on time. Maybe you got delayed for whatever reason, and you're coming in 10 minutes late. And fair enough. I should have that in the screen, on the screen for you guys. Anyway, everybody, take care. Keep up the good work. And Joe, apologies sending you that email. Tomorrow my morning hours, so you will have it in the evening. Take care. Bye bye.